Okay, so when it comes to value investing, there's a couple of approaches that you may have heard or may be familiar with. These are certainly approaches that I have read a lot about over the past 10 years for sure. And so there's the Warren Buffett approach, which we would consider possibly one of the greatest value investors of all time. A lot of people say that about Warren, but I would say let's not forget about his longtime partner, Charlie Munger, who also fantastic investor, very, very smart guy. And we lost Charlie last year. And I would say it's hard to have Warren without Charlie and vice versa. To me, they're hand in hand. But anyway, the Warren Buffett approach is, or I could say the Berkshire Hathaway approach is to look for companies with strong moats. Think about a castle that's going to have a wide moat and a deep moat, and that means that they're not going to be as easily penetrable. And the same thing is true when you're looking for these companies. You want somebody that has a wide competitive advantage that will protect them from being overtaken by competition or fast competition. And in an AI-driven world, that's becoming a little bit more difficult to do with technology. But there are still some places where you can find a good moat, not only an economic moat or a wide gap, but definitely a competitive one, and that's what you're looking for. Benjamin Graham's approach. Benjamin Graham wrote a book called The Intelligent Investor. It was the first serious investment book that I ever read. Warren Buffett was one of his students. Ben Graham's approach is buying stocks for less than what they're really worth, which is what we're doing here. And the book goes through a lot of ways to pencil that out. And some of it is still current. The book was written a very long time ago. I want to say like 1950s, 54, 56, somewhere in that range, if I remember correctly. But a lot of that still holds true. And so he's looking for strong companies with low debt, steady earnings, and they leave a margin of safety, free cash flow, to reduce risk. There's another book that I read a long time ago called The Little Book That Beats the Market. It's by Joel Greenblatt, and he has what he called a magic formula for finding undervalued companies, and it focuses on buying good companies at bargain prices. And you do this by ranking stocks based on, number one, a high return on capital. I just talked about that a couple of minutes ago. It means that the company and the management is very efficient at taking money and turning it into investment that leads to profit.